Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for October 3rd of 2022. See our disclaimer for important information. We'll start off this week with the slide that I used in my discussion for my special market minutes this past week, something that really caught my attention. And this is from Charlie Bolello, and it's looking at a traditional 60-40 growth portfolio over a long period of time. In fact, 94 years in this particular chart here. And that means 60% equities, 40% fixed income. Now, the equity side is comprised of the S&P 500 index, and the fixed income side is comprised of the U.S. aggregate bond index. So just very straightforward indices being used here. And basically, the takeaway from this is that if you look at the full spectrum, right? And this has been a very, very, very odd year, extremely odd year in terms of the performance of both the equity and the fixed income markets, both being so weak this year. And so we're on pace for having, essentially one of the worst years that we've ever seen in a 60-40 portfolio, only eclipsed by 1931. And you can see in this chart, since 1928, there have only been 20 instances where a 60-40 portfolio, again, a traditional growth portfolio, has witnessed a negative return. And not since, like I said, 1931, have we seen anything on pace anywhere close to what we're witnessing here. 1937 was also a fairly bad period as well. But as you can see here, when you have a stretch, and again, 1929 to 32 was the longest stretch that we've ever seen. We've never outside of that had more than 2 years where we had consecutive negative returns in a 60-40 portfolio. But Great Depression was obviously an aberration. However, when you look past the Great Depression, we had some really good years. And when we have these negative years, we tend to have a stretch or a run of some good years that follow. Even in the years that we have like 2 consecutive negative years. And I'm not saying that we're on pace for that. I think there's an argument to be made that markets are oversold, equity markets are oversold at this point. Not that they can't go lower, because they might, but they're not necessarily oversold. Or excuse me, that they are oversold on a short-term basis. But over longer periods of time for longer horizon portfolios, that you tend to see this rebound over multiple years when you have one of these negative years in a 60-40 portfolio. So just some perspective for us as we kind of start the chart pack this week. Well, now we'll go ahead and transition into some other very interesting slides. We have a lot in the slide pack this week, so I'm going to try to get through these fairly briskly. But, there's puts and takes along the way, but some interesting observations here. And this is one of those. Evercore ISI company surveys are actually not that bad. When you think that we're heading into a recession, you would expect that these company surveys to be a little bit more somber. And I think, and the fact that there are really very few structural deficiencies in our economy that need to be rectified, unlike, say, 2008, when we had a massive imbalance of risk shifting onto these credit default swaps and banks that were making liar loans and things like that. We don't have that this time, and companies are in relatively good shape. Consumers are in relatively good shape, again, relative to prior downturns, again, to make that distinction. But these surveys are not what you'd expect if you are heading kind of headlong into a recession. That's what makes me think that, and the fact that we don't have these structural deficiencies, that a recession that we do see is going to be somewhat mild in nature. Now, somewhat of an offset to that is the global picture, and I do think that the global picture is not as constructive as the U.S. picture is. And again, I think we are moving closer to a global recession. We may see a profits recession here in the U.S., but global economic growth here is defined by the Global Composite Purchasing Managers Index, or the global PMI, is likely to be negative for another quarter here. And I do think there's a reason why we've paired a lot of the international positions in portfolios is being cognizant of the fact that the global environment, particularly Europe and also Asia, we see less constructive data coming out of China right now. that environment is not nearly as constructive as the U.S., which itself is obviously witnessing some headwinds here. Number of central banks. We have had a tremendous amount of hikes. And again, the U.S. has been at the forefront of that, been very aggressive in their rhetoric and in their actions. And so as a result, we've seen an extremely strong dollar this year, which has put pressure on other foreign central banks to defend their currencies by moving their rates higher as well. But we see a number of hikes, less cuts in this particular chart here. This is presupposing that perhaps we're near a peak. And I think, there's going to be a lot of pressure on central banks to actually begin to provide relief because as we saw in the prior chart that we've got, global PMI turning negative likely for a second consecutive quarter. And I think that's important because then that's going to put pressure on central banks to actually begin easing, perhaps a little bit sooner than the U.S. is going to be in position to do. Short duration stocks, this would be the difference between like high flying technology firms that tend to have very large multiples because you're betting on many years ahead on financial performance, and that's why you ascribe high multiples to some of these growth stocks, if you will, because you expect them to grow well into the future. Well, those are kind of long duration stocks, and short duration stocks, as depicted here, have performed much better, and particularly from August 2020 until now. I mean, it's like been no comparison whatsoever. These long duration stocks, the high flying tech stocks, et cetera, have really underperformed in this environment. High dividend paying stocks, on the other hand, have also done extremely well. So when you think about, in the prior slide, we had short duration. These are companies that cash flow well, that have defensible earning streams, strong cash flow. And these companies tend to also pay high and consistent dividends. And so when you look at the combination of short duration stocks and short duration stocks that pay dividends, that has been the best place in the market. And that's where we've tried to focus a lot of our energies in at least the equity portfolio side of the equation. Total assets by all Federal Reserve banks. Now we are beginning to see, this quantitative tightening really take hold. I mean, obviously, we know the Fed is raising interest rates, but what they're also doing is they are shrinking their own balance sheet. You can see here about $150 billion from its April peak, and we knew that they were really going to begin in earnest in June. And so, we can see probably ahead of us about another $2 trillion being taken off the Fed's balance sheet over the next couple of years. Again, that's going to slow the money supply, and we've got a chart on that. Money supply is extremely important as a fuel and a feedstock to inflation. As you see this money being pulled off the market, I can tell you that money supply issue is going to have much more bearing on the pace of inflation than interest rate increases that are much more highly publicized are. Median household payment as a percent of median income. Now, no secret that there has been stress on the consumer. No secret that we've seen a stall in the residential real estate market. We do see inventory moving higher. We do see mortgage rates moving higher. We've got a chart on that. I think the rate briefly touched 7% this past week, which is a tremendous change in literally just a handful of months. But you can see here, housing payments with those rising rates and rising prices, 44%, 44.5% of median income is moving higher. Here's a housing market index. This is the NAHB, the National Association of Home Builders. You can see that their optimism has waned, obviously, with some of the issues that I just spoke about in the prior chart. Now, you've got higher interest rates, you've got higher prices. Prices are coming off their peaks in some areas, but you still have affordability that's a bit more challenged, even though you've got some commodity cost headwinds that are really going away for a lot of these builders. And we've seen on the basis of like 1,000 board feet, lumber prices are back below their pre-pandemic levels, which is a huge turnaround Not to say that there aren't supply chain issues and people maybe having trouble finding trusses and windows and things like that, but cost for that and shipping delays are not nearly as bad as they were. But home builder sentiment here is definitely off its peak, and you can see a line of best fit here is essentially that 50-50 line. So anything below that represents builders feeling that conditions are perhaps a little bit more poor than they have been. Median home sales price, we see this coming off the top. You can see this reflected in the rise in the number of deals that are being done in the residential real estate space that are below asking price. We're seeing 85 to 90% of asking price being transacted right now, and also we're seeing asking prices at the outset coming down as well. We see that here. This is a national chart, and it's clearly telling us that the issues incumbent with the broader economy are clearly impacting the residential housing space. Here's the dollar index. Now, we talked about that a few minutes ago. Dollar is exceptionally strong because the U.S. Federal Reserve has been well ahead of the curve. I'd say, well, that's relative. I guess last year they were well behind the recognition of inflation being a real problem, but they're well ahead of the global curve in terms of their aggressiveness in moving rates higher. And you can see we're at the highest level on the dollar since 2002, and that is because of the aggressive Fed. And it's kind of at an unsustainable rate of increase, but I do expect the dollar to remain high for the foreseeable term. It's a chart that came out of Richard Bernstein, really interesting here. Quarterly returns, you can see, when the Fed is easing and profits are accelerating, that's the best environment you can get. Now, even when tightening, there is a reasonably good environment when the Fed is tightening and you have accelerating profits. You can see here, anywhere between 3.5% to 4% average return, and with a meaningful yet not overly cumbersome probability of loss in the S&P 500. Now, on the flip side, the worst environment there is in the red, and that's where you have tightening conditions, which we do, and decelerating profits, which we also do. So in that environment, we have a 43% probability of loss and a fairly meager average rate of return. And so that's the part that we're watching right now. This is part of what Richard Bernstein Advisors research was really focusing on, is where are we in this quadrant here? And when do we shift to a less decelerating profit environment, or perhaps when we shift to more of an easing environment where we still have profits decelerating? You can see that those scenarios are a little bit better than what we're seeing now. Here's our Fed funds rate on a real basis. This is subtracting inflation. You can see that that we've made a tremendous change in the real funds rate, and with inflation being relatively high, you can see how this is kind of transgressed over time. And during the 80s and 90s, for the bulk of that time, we had real positive interest rates there. And obviously, we had high interest rates, period. But when you subtracted out high inflation, they were still relatively high, but that's obviously reversed now. And so when you have this environment and you don't have a kind of a Fed put, if you will, it just creates more volatility inherently in the equity markets. Here's trailing EPS growth. And so this is what we're talking about in terms of decelerating profits. And this is also from Richard Bernstein. You can see some of this represents their analysis, which is, I'd say, pretty consistent across the board, that we're expecting either a relatively benign earnings environment, really benign, like low single digits, or negative in the case of what RBA is forecasting here. And you can see the deceleration coming off of this rebound, which is coming off of this artificial shutdown during the pandemic and so on and so forth. So this is all a part of this oscillation that gets us to a more normalized rate of growth. And so we have to get through this period. And RBA is actually expecting weak earnings on a trailing year-over-year basis through the end of next year. And so that means, like, if you look into the fourth quarter of next year, they're looking for, perhaps negative 4 to 5%. But that's looking at basically the trailing 4 quarters, a trailing year. And so we do expect the numbers to look much more bleak, perhaps over the next 6 months than perhaps they will in the next 12. Performance when profits are decelerating. So it's a consistent theme, through this research piece with RBA that I thought was particularly interesting. And this is just looking at it on a sector basis. And so, if you are going to make a sector bet, and everyone if the sector bet, the only one to make really on a fairly consistent basis over the last 12 to 15 months has been energy. But now looking ahead, when you see the environment that is likely in front of us, then you've got more of these defensible areas. Again, going back to what I said earlier, where we've had outperformance from short duration stocks that have high dividends. And these short duration stocks are what's characterized in the left-hand side of this chart. Healthcare, consumer staples like Kimberly-Clark, Colgate, those types of things, utilities, and then commercial services. And you see when you get over into this environment that energy is not as likely to have as good a performance in this environment where we're witnessing a profits deceleration. Here's lumber prices. I mentioned this earlier. I mean, we're basically back down to where we were, pre-pandemic. You can see the huge gyrations in the price of 1,000 board feet. And so this is very kind of emblematic of a lot of different commodities. But this one was notable in the sense that we had two very specific times where lumber was not only in short supply, but it was exceptionally expensive. And a lot of those headwinds have been cleared in the wake of slowing growth. Here's a look at Fed funds rate across tightening cycles. And then on the right-hand side, we have kind of the best guesstimate, the consensus estimate, if you will, for the terminal rate. Where is the Fed's short-term rate likely to end before it goes back down, like the peak of this particular tightening cycle, if you will? And so, that number is about 4.8%. So we're obviously a long ways away from that, but it is reflective of this notion that we're going to get perhaps another 75 basis points of tightening here in the next meeting, perhaps another 50 basis points beyond that. And this is all largely priced into the market. The left-hand side, we've got that red line where it shows us that, and this is a Ernst & Young Parthenon forecast based on Federal Reserve data. And you can see in the non-red lines that this represents what's happened in the past in these prior tightening cycles, if you will. And so, this particular estimate shows us, to be about 6 months into this tightening cycle, probably a little bit longer than that now that we're officially in October, but expecting the rates to move higher and then plateau before they go back down in about another, call it 9 months, if you will. So, and as I've been saying, I think the next 6 to 9 months are going to be the most challenging part of this very challenging environment that we have. And I think the next 6 to 9 months, and perhaps the next 6 months, are going to be the real test. We get through that, market's going to begin to anticipate these rate decreases. The market's going to begin to anticipate a new cycle. They're going to begin to see the evidence of more tangible slowdown. But again, without these big structural problems in our economy, that recession, when it shows itself, should be much more mild in nature. Now, that's not, there are risk factors to this, but right now what we see is a mild recession, a global recession overall, but milder here in the U.S. And then when the market begins to anticipate that you're towards the end of that, you often see market performance begin to reassert itself even before you have confirmation, perhaps in some cases, that you've even been in a recession. And certainly, when you have the visibility that maybe you're coming out of it, the markets tend to want to perform because you have more money being allocated to risk capital at that point, with the expectation that you're hitting an emerging new market cycle. Capex Outlooks. Now, this kind of goes back to the sentiments. Now, the companies that are surveyed, and we saw this in one of our first slides, those surveys are not, that terrible. But generally, when you feel like the demand environment is going to be weaker, you're less inclined to want to commit capital spending to expanding plant, property, and equipment. And you can see here that there's evidenced corporate capex year over year. That's in the solid line, and the light blue line is pulled forward by 18 months. It's kind of a leading indicator. So you can see that as a leading indicator is likely to roll over, and we're expecting to see more capital spending curtailments. Not too surprising given the current environment. Share of small businesses with positions not able to fill. Now, we have still a very high ratio of open positions to people that are available to fill those positions. And usually in a recession, you see that erode somewhat. So I think to get the Fed more comfortable, you'd have to see this line roll over a little bit. And you can see where it does in these shaded areas. These shaded bars represent recessions, and you see where that typically does roll over, and we just haven't seen that yet. In fact, if anything, we might have had a slight uptick, but again, labor market's still strong. And I think when you think about the Fed's dual mandate of stable prices and full employment, that one is inherently at odds with the other. So obviously the goal right here cannot be, when you're dealing with inflation and you're advertising the fact that is your mission right now, is to fight inflation, then you're not going to be concerned with full employment. And right now, we just haven't seen that employment side roll over, and we haven't seen the unemployment rate materially pick up. A technical factor, so from Fidelity and Yuan shows us that, this is I look at kind of that light amber line that oscillates around that midpoint there. And what it tells us right now, with the number being so low, that we just have a fairly oversold condition on a short-term basis right now. And that is just, just where we are from a relative strength indicator, what they call RSI. And you look at where the market has been, that's in the black line, but the relative strength is actually extremely weak. And when you see conditions this week, you typically see a bounce. Now, the feeling here is that you're apt to see another bounce, kind of like we did in July, but that the market then has probably 10% downside from there. And when you start talking about the market itself, the S&P 500 being down around 25%, I mean, that's within striking distance of an average decline for a bear market recessionary environment. And that's a bear market that is also accompanied by recession, which is where I think we're going. And we are, well into that cell. And I think the market is very much pricing in the likelihood of the recession. And when you look at, kind of a normalized earnings, when you look at a recession era, earnings number for 2023, again, thinking ahead, if it's like 210, then what we have now is about 17 times that, which is not out of line whatsoever. Looking ahead into the next 12 to call it the next 12 to 15 months. So again, I think maybe a little bit more downside here, short-term oversold, work through the next 6 to at most, I think 9 months, the market begins to anticipate the next market cycle coming out of this. Corporate bankruptcy, another something that I came across that actually just blew me away. That honestly, corporate balance sheets are in really strong shape. This is what I was talking about earlier about there really not being a lot of structural problems here. We don't see corporate bankruptcies spike, which we would have seen in prior downturns, and we would have expected to already see now if if we weren't in such reasonably good shape from a corporate P&L standpoint. But again, this is one of those things that just jumps out at you. It's like if we're heading towards inflation, or excuse me, recession because of this inflation-induced demand decline, you would expect to see the corporate bankruptcies and delinquencies move higher, and we just have not yet. This is the money supply, and so maybe a little bit harder to read, but we were looking at money supply earlier and talking about it for sure. But this is honestly the most important factor in our ability to control inflation. If you reduce the money supply, and right now the year-over-year growth rate in M2 money supply is 4.1%. You can see that we haven't been here since roughly 2018, 2019. We had a lot of juice in the system during the pandemic, and that's really come off the top. And this juice has absolutely helped to fuel inflation. You've got a lot of money chasing a finite number of goods, and then when you choke off the economy, shut down production, you have less goods out there. I mean, absolutely. And this stuff always works at a lag too, which is also important because, when during 2020, we had huge goods demand, prices went up because there were a lot of shortages. 2021, same deal, but the hyperinflation that the Fed just completely missed really kicked in the second half of 2021 and into this year. And so we see that money supply dropping like a rock like it has. This will help us fight inflation as we get about 6 months down the road. And if it's not going to help us sooner than that, it certainly will over a period of time. And this is honestly much more important than just pure interest rate increases. Here's the Chinese yuan. When I talk about the struggle in emerging markets, the Chinese have gone to great lengths to try to peg their yuan, or alternatively the renminbi, to the dollar. You can see here that it's very difficult when you have this environment. The Chinese economy slowing down on both a relative and an absolute basis, and you have the U.S. raising rates fairly aggressively, and it just provides a disconnect. And I think that there are some serious structural imbalances with China that make it a difficult place right now, and I think it clouds the whole opportunity set for the emerging markets now in general. Higher rates, defined benefit plans. Here's something else that just really kind of blew me away. We went through many years and pockets of time where we had fairly strong worries about the sustainability of defined benefit plans, kind of the traditional pension plans out there, their funded status and their ability to pay retirees. And, we have on a federal level, we have the Pension Benefit Guarantee Trust that bails these pensions out. And obviously you've seen a lot of Fortune 500 companies move away from defined benefit into defined contributions, i.e. 401ks. But the good news here is that we see defined benefit funding status because of these higher rates. This is one of these unintended benefits that when you have higher rates, it helps savers. It helps these pension plans earn higher rates of return, not only on cash, but the fixed income portfolios. And we actually have a fairly good funded status for our pension plans right now. Global money supply. So we saw this chart just a few slides ago where the US is dropping to 4.1. This is the global money supply, and it's also coming down. Again, this is all going to be very material for us in terms of the ability for the world to fight inflation. And it does operate at a bit of a lag, but as we see this roll over, and you can see really we peaked about February this year in terms of our global money supply. Look at that amber line. The black line just represents the S&P 500. And you can see the correlation there too. When money supply when you're juicing the economy, whether it be the U.S. or the global environment, you're juicing that. You're going to juice your stock returns. You're going to juice your risk markets, and that's exactly what happened. When you pull the punch bowl away, it takes a lot of the momentum out of the equity markets and these risk capital markets, and you can clearly see that that's the case here. But money supply is slowing down, and it's going to help our inflation. And again, at some point, this money supply decline is going to taper off, and then you're going to have it maybe flattening out. And then that's the point where you should get more excited about the equity markets. And again, I think that all happens here in this 6 to 9 month time frame. 30-year fixed mortgage, 6.7 in this, but actually, honestly, this is maybe a couple of days dated because we actually did touch over 7% briefly. And you can see the mercuric rise in that number in a very, very short period of time. Here is the container freight cost from Shanghai to Los Angeles for the Port of LA. I saw this in a post from Liz Ann Saunders at Charles Schwab. It's phenomenal. Again, just like lumber prices, it's phenomenal how we've round tripped on this. We had container prices that were exceptionally high. We had port clogs. We had all sorts of supply chain problems, and these costs went through the roof. You can see here. Now we have essentially had a 73% decline in these prices in I'll call it maybe a year, and for roughly a year, we can average that out. But a tremendous move in freight costs. Again, this is disinflationary, just as lumber prices are, just as other industrial commodities that have come off are into the economy. Here is Liz Ann here with something that caught my attention. I just captured the text as well in this. But we've had 3 consecutive quarters of declines for both the S&P 500 and the aggregate bond index. We talked at the very first slide about Charlie Bilello's table showing the 20 times over the last 94 years where we've had a negative return for the 60-40 portfolio. Well, you have to go back to you have to go back at least to 1976, where you had 3 consecutive quarters of decline. Now, Charlie's table was about annual returns for a 60-40 portfolio, but we've never seen in the modern era here 3 consecutive quarters of declines for both the S&P 500 and the aggregate bond index. Just think about that. That is tectonic. You see these amber lines are typically positive, so you generally don't see you don't typically see negative performance out of bonds, but when you do, it's short-lived, it's not necessarily significant. So the environment that we have now is, I'll just reiterate one more time here, is so exceptionally odd and unusual that it just bears worth noting. Well, this is a very busy table, but again, from Charlie Bilello. And so we're about 267 days in that highlighted block there, S&P 500 corrections of more than 5%. And now you can see, since the 2019 March low, before we hit that new market cycle, you can see the various reasons of that. But, I mean, this is the longest correction period that we've seen since that low. Atlanta Fed. Now we're going to start to see some of this rhetoric begin to emerge, and the Atlanta Fed. I'll just have you focus on that green line that jumps around a lot, and this is the Atlanta Fed's GDP Now estimate. And so you can see on the left-hand margin is your scale that just as recently as like a couple weeks ago, they were expecting, a fraction of 1% growth for the third quarter. And now they've suddenly, this quantitative model that they've built, which is actually done okay, I guess, over time, is now expecting something on the order of 2.4% for the third quarter. And we're going to begin to see these types of forecasts. And I do think, because there's kind of you know, well, I just say that I it wouldn't surprise me to see a divergence in some of these models, and just as we did in the last quarter, some that predicted a decline, some that actually predicted a fairly decent gain, but these models tend to be divergent. You can see the blue chip consensus, which is just the analyst community expecting a pretty weak environment. We haven't seen an update in a few weeks there. I expect that to be pretty weak, but just interesting that we have the Atlanta Fed and we have the Fed president there that has been on record as having been a hawk, somebody who advocates continued rate increases. So it's interesting that their own Fed is advocating for a higher GDP number for the third quarter. Anatomy of a correction. This is our last slide, and this is a big old spaghetti plot here that just shows you all these different corrections. Again, I just mentioned that we're 267, 270 days into this current correction, if you will, which is the longest stretch that we've seen since 2009. But you can see that at least on this basis, and this is as of 925, so we're actually a little bit lower than this now, but you can see that the preponderance of occurrences previously would tend to suggest a higher outcome, but still, there could be some continued downside. That's why we're taking some money off the table. You can see that there's a few of these occurrences that go way south. And we know that 2008, 2009, when we had some serious structural imbalances, I mean, major structural imbalances had to be worked out. And that was a time where the market did go down considerably following where we are in the current correction cycle. But there's just as equal opportunity for us to go up. I'd say that, we're oversold in the short term on a relative basis. Maybe we get a little bear market rally, and then at some point, maybe we see it a little soft again before it gets better. But again, this chart is just simply here to highlight the fact that, there's a lot of different ways that we can go, and we should be prepared for a lot of different eventualities. All we've got for this week. Hope you've enjoyed the chart pack. There's a lot of data packed in here, but a lot of interesting stuff this week. So hope you've enjoyed it. Please call with any questions. Have a great week. We'll talk to you again soon. Take care. Bye.